Hello everyone, my name is Rohan Sharma, student ID 22100110155. So coming to the slide introduction. Marginal cost is defined as the change in aggregate cost due to change in the volume of production by 1 unit. Marginal cost is the additional cost incurred in the production of one more unit of a good or service. It is derived from the variable cost of production given that fixed costs do not change as output changes. Hence no additional fixed cost is incurred in producing another unit of good or service once production has already started. Next slide, marginal costing and formulas. Marginal costing is a costing technique wherein the marginal cost variable cost is charged to unit of cost while the fixed cost for the period is completely written off against the contribution. A settlement of cost and measuring the impact on profits of the change and the volume of output or type of output. Marginal costing is a very useful technique of costing for decision making. In marginal costing, costs are segregated into fixed and variable. Formula of marginal costing equal to prime cost plus total variable overheads. Now coming to this next slide will be presented by Rajdeep Chaudhary.
Hello everyone, my name is Rajiv Chaudhary, student ID 2210011015560. My topic is features of marginal costing. It is a technique of control and decision making. Selling price is based on marginal cost plus the contribution. Profit is calculated by deducting marginal cost and fixed cost. Cost volume profit in bracket break-even analysis is one of the integral part of marginal costing. Valuation of stock of work in progress and finished goods is done on the basis of marginal cost. Now, the concepts and terms of marginal costing, that is fixed cost, variable cost, contribution, profit volume ratio, break even point, margin of safety. So, in the next slide, it will be broadly elaborated by my friend Sushmit.
Hello everyone, my name is Susmit Ghosh, student ID 2210011011530. My topic is fixed cost, known as period cost or time cost that does not depend on volume of production and sales. Fixed cost remain constant. Fixed costs are fixed in unit. Example: salary, rent, manager salary, etc. known as fixed overheads. Variable cost increased and decreased in proportion to sales and output, called as product cost or marginal cost, vary in direct proportion to output. Variable costs vary in total but they remain constant per unit. Example: direct material and direct wages. Now comes the contribution. Contribution is the difference between sales and variable cost. Contribution is also known as contribution margin or gross margin. So here come the formulas: contribution equal to sales minus variable cost and so on. So the next slide will be represented by Udit Raha.
Okay, so my name is Udit Raha and my student ID is 2210011011542. So I am going to discuss about the profit volume ratio. It is all about indicates the relationship between the contribution and sales, and it is usually expressed in percentage, and high profit volume ratio indicates high profitability, whereas low profit volume ratio indicates low profitability. And the formula stated is contribution divided by sales into 100, that is change in profit divided by change in sales into 100. Whereas the break even point describes as the point where total cost, expense and total sales revenue are equal. That means when the total sales, total revenue and total cost incurred is equal, that is called the break even point. And the formula is that fixed cost by contribution per unit, whereas it is also stated as BP unit into selling price. And the margin of safety is that it measures the distance between the budgeted sales and break even sales. So the formula is that actual sales minus break even sales, or it can also be written as profit by PV ratio. So the next slide will be represented by Vishal.
Hello everyone, my name is Vishal Kumar Shaw. My student ID is 221001101509. We will discuss about advantage of marginal cost. Now we know about what is advantage of marginal costing. It is simple to understand and easy to operate. It is helps in evaluation of performance of different department, division, product, salesman, etc. It provides the management with useful techniques like break-even analysis, PV ratio, etc. It is very useful tool of profit planning. It guides the management about the profitability at various level of production and sales. Now we are shifting to another slide, is limitation of marginal costing. The classification of total cost into fixed and variable cost is difficult, sometimes lead to mislead result in marginal cost. Historical data is used while managing decisions related to future events. It does not provide standard for the evaluation of performance. Selling price fixed on the basis of marginal cost will be useful only for short period of time. Assessment of profitability on the marginal cost base can be used only in the short period of time. Conclusion of marginal cost. It is important tool for pricing, budgeting, decision making, and help business to understand the cost, revenue, and profitability of different products or service and make informed decision about product and pricing. So the slides are ended here.